So in this lecture I will discuss about functions of RBI, and by discussing functions of RBI some of the important banking terms, banking concepts will come up. So first important function of RBI is issuance of currency. Issuance of currency. This is the first function of RBI, and under section 22 of RBI Act 1934, RBI has the sole authority to issue currency notes, which are also called as bank notes. Under sign of Governor of RBI, and except 1 rupee note issued by Ministry of Finance, which is with the sign of Finance Secretary. So this is the case with the issuance of currency. Some important point under issuance of currency is that since 1957 RBI is required to maintain gold and foreign exchange reserves. Gold and foreign exchange reserves of rupees 200 crore, of value 200 crores, and out of this gold of at least value rupees 115 crore, means out of which at least rupees 115 crores should be in gold form, and this is on the as a reserve. So this concept is known as minimum reserve system. This is the main function of RBI. Now comes the second function. So again, the important function is banker to government. RBI act as a banker to central government or union government, even for state government also. So how it will act as banker to government? Because under section 20 for central government and section 21A for a state government. For a state government of RBI Act 1934, RBI transacts government business and manages public debt. Means whenever there is mismatch between receipts and expenditure, it is nothing but income of the government. Whenever there is mismatch between income and the expenditure, then RBI provides the necessary cash flow to both state and central government. It is just a simple concept, like when our expenditure is increased by income, then some of the time we face some problem and we need money from our friends, from our parents. So it is just like that. When government comes in that situation, RBI provides the credit, necessary cash flow to the central government or state. And this phenomena of providing necessary credit to state and central government is known as receipts and expenditure of government. RBI provides the cash flow. RBI provides the cash flow in case whenever there is mismatch between receipts and expenditure of both the central and state government, and this phenomena is known as ways and means advances. Ways and means advances. This whole phenomena is ways and means advances. And under this, state government can withdraw an overdraft for maximum of state government can withdraw overdraft for maximum 14 days, and central government can withdraw overdraft for maximum 10 days, 10 consecutive days. Apart from that, RBI charges penalty that is linked with repo rate. That I will tell you later what is repo rate. So this is the concept behind this function of RBI, banker to the government. Next comes controller and supervisor of banks. All the commercial banks actually acts as a controller and supervisor of all the commercial banks. Now, in this case, RBI is responsible for controlling overall operations of all the commercial banks in India. What are the banks? Public sector banks, private sector banks, foreign banks, cooperative banks, and regional rural banks, RRBs. So these are the types of banks over which RBI has the control and supervision. And most of the time question comes that what are the two main acts which are responsible, which are used by RBI for controlling and supervision of all the commercial banks. So the two acts are, first one is RBI Act, RBI Act 1934, and the second one is Banking Regulation Act, Banking Regulation Act 1949. These are the two main acts which are responsible for control and supervision of all the commercial banks. In combination of both these acts, RBI controls the overall operations of banks. Now comes the next function. Next, and another very important function is formulator of monetary policy. Monetary policy of India. This is again very important function of RBI. Now, what is this about? RBI formulates monetary policy twice a year. Monetary policy for twice a year. Formulates mean it makes fresh policy, monetary policy twice in a year, means 6 monthly, and it reviews the policy, reviews the monetary policy in every quarter. In every quarter. In every quarter means 4 times. 4 times in a year it reviews, and 2 times in a year it formulates monetary policy. So what is the main objective of monetary policy? Objectives of monetary policy are: first, inflation control. Inflation. What is inflation? Inflation is nothing but general increase of price with respect to the previous year. Next, second objective is control on bank credit. Control on bank credit. And the third one is interest rate control. Interest rate control. These are the three main objectives of monetary policy: inflation control, control on bank credit, interest rate control. And when you combine these two, it is again a separate function, which generally RBI's main separate function is credit control. So this is all about monetary policy and objectives of monetary policy. Now, some of the tools used by RBI under monetary policy formulation and monitoring. Tools. What are the tools? First, open market operation. Now, the question comes, what is open market operation? Open market operation is nothing but buying and selling government securities by RBI in open market. To control supply of money. What is this supply of money, and especially where? In banking system. So most of the time we didn't understand what is the control of supply of money in banking system, how it will control by buying and selling government securities. So the concept is, when there is excess supply of money in the market or in the economy, and then central bank sells government securities. For example, this is RBI. These are the different banks. Okay. So here, what RBI do when there are excess supply, means there is huge amount of money in the banking system. RBI used to sell government securities, means it will sell government securities in exchange of money. So all the excess money which a banking system has to give to the RBI, and they have to take the government security. This is the open market operation. So whenever there is excess supply of money in the market, then central bank RBI sells government securities, thereby sucking out excess liquidity from the market. And similarly, when the liquidity is tight, liquidity is nothing but supply of money in the economy, banking system, whatever you can say. So whenever the liquidity is tight, means less money in the market, then RBI will buy. It's just reverse. Whenever there is liquidity is less, means less money in the market, then it will buy back the government securities and give the money to the banking system. So this is the main concept of open market operations, buying and selling of government securities and thereby maintaining the supply of money in the market. So this is the first tool used under monetary policy. Now comes the second one, CRR. What it is? Cash reserve ratio. What is this all about? The main concept behind this is, for example, just take it pictorially. This is RBI. These are the banks, different banks. Okay, these are the banks. This is another thing. This is currency chest. Okay, now what is this cash reserve ratio? Is all the commercial banks are required to keep certain amount of its deposits in cash with RBI. Means they have to keep daily certain amount of its daily deposits in cash with RBI, and this percentage is called cash reserve ratio. Means they have to keep certain amount of its deposit with currency chest, and currency chest will in turn provide it to the two-way path to the RBI. Now the question comes, why I have tell the concept of currency chest. The logic behind this is RBI has a limited space, limited office space, limited space to keep all the cash, all the assets and important documents, government securities of the banks. Now the question comes that on daily basis, how RBI will keep the CRR, cash reserve ratios amount with himself. Okay, so for that purpose RBI has assigned currency chest in every district, in every city with regard to one particular bank. There are different currency chests. Okay, so on daily basis they have to keep the cash reserve ratio money, certain percentage of money of its deposit with the currency chest, and currency chest is nothing but agent of RBI. It acts as the agent of RBI. So here currency chest will maintain the cash reserve ratio amount of the banks, and it will provide to the RBI whenever RBI needs it. So cash reserve ratio is nothing but certain amount of bank's deposits. They have to keep certain amount of its deposits in cash, specifically in cash, not in gold or securities, with RBI. So what it will basically do is, what are the main objective of maintaining CRR is, it ensures that the portion of bank's deposit is totally risk free. Means in case of emergency, it is nothing but a forceful savings by banks. Okay, so it makes the bank's deposit totally risk free. In future, whenever there is a cash crunch or any problem occurs, then every bank has its own CRR amount, at least own CRR amount ready to use. That's why it makes the bank's deposit totally risk-free. And secondly, it enables that RBI control liquidity in the system and thereby inflation. Means whenever there is excess, whenever there is excess money in the excess liquidity in the banking system or economy, then it will increase the CRR amount. So banks have to keep that much amount of money with the RBI, so it will sucks out excess money and controls the inflation. So again, I will tell you that main definition: all commercial banks are required to keep certain amount of its deposit in cash with RBI, and this percentage is called cash reserve ratio, and it ensures that a portion of bank deposit is totally risk free, and secondly, it enables RBI control liquidity in the system and thereby inflation. Now comes the third tool, SLR. A statutory liquidity ratio. Actually, it is defined under section 24(2)(a) of Banking Regulation Act 1949. Now, what it is? Basically, these are the banks. These are the banks, commercial banks. So the concept behind SLR is that banks in India are required to maintain certain percentage of their total net demand and time liabilities. Total net demand and time liabilities in form of government securities and approved securities such as gold, cash or other approved securities, precious metals for example. And they have to keep these securities and these precious metals certain percentage with themselves, not with RBI. So what SLR does is again restrict the bank's leverage in pumping more money into the economy by investing a portion of their deposits in government securities. Precious metals such as gold and in cash also. Okay, and they have to keep these securities, precious metals and approved securities with themselves, not with RBI. This is the main difference, and it is around 20 to 25%, and the percentage count is again regarding total percentage of total net demand and time liabilities. Now the question comes, what is this net demand and time liabilities? Demand liability is nothing but demand liability for a bank is nothing but current account balance and saving balance, because they are demand accounts. How come? Means in case of current account and saving account, customer can withdraw or can submit money, can deposit money anytime whenever they demand. So it is not restricted. So this is the demand liability for a bank. Okay. And time liability is nothing but FDs, fixed deposit, RDs, golds, securities. These are all time liabilities. Time. Okay. So some of the portion of this and this, and in SLR, in case of SLR, saving accounts balance is not included. Current account, only current account balance is included. And in case of SLR, some of the components which banks have to include in maintaining SLR are cash in hand, balance with RBI, net balance in current account, not in saving account. Current account, and investment in government securities, and other approved securities, and gold and other precious metals. Okay, these are the main components that banks has to maintain as statutory liquidity ratio.